Welcome in the first of two videos on the chapter on premium calculation, which is based on chapter 6 in the book Actuarial Mathematics for Life Contingent Risks. In this chapter, in these two videos, we will have a look at net and gross premiums. We will define net and gross premiums. We will also define the loss at issue random variable, and then we will look at what is a premium calculation principle. How do you calculate premiums in a life insurance context? We will, in particular, give attention to the equivalence premium principle, which is the basic premium principle in practice, in life insurance practice. In the book, there is also something written about another principle, the portfolio percentile premium principle, but we will not consider that issue. Then there is in the book also a section on profit in an insurance policy. And then there is also a section on premiums for non-standard, that means increased risks. What is a life insurance contract? A life insurance contract is in fact nothing else than a complicated swap. Essentially, there is a transfer of premiums from one party to another party, and there is insurance benefits that are paid from the insurance company to the client. Or let us have a look more in detail at this complicated swap. In fact, there are four parties involved. First of all, there is the insurance company, and central is of course the policy. The insurance company issues the policy. The policyholder is the person who underwrites the contract with the insurance company, who pays the premiums, let's say. The insured person is the life on which the policy is taken out on. So that means the benefits that are paid upon survival or upon death depend on the survival or not of the insured person. And then finally, there is the beneficiary. The beneficiary is the person who will receive the benefits upon survival or upon death of the insured. So summarizing, you have the insurer, the policyholder, the beneficiary, and the insured person. What happens now with the cash flow transfer? The policyholder will pay gross premiums to the insurance company. Gross premiums means he pays for the insurance benefits, but also for the expenses related to the policy. And the insurance company will then pay benefits to the beneficiary, but will also make expenses related to the maintenance and the keeping the policy. Net premiums and gross premiums. What is the difference? Net premiums only cover the benefits. The gross premiums cover the benefits and also the expenses related to the contract. So the gross premiums are the net premiums plus loadings, extra premiums, let's say, for expenses. How does a life insurance contract works? Very simply stated, there is a policyholder's savings account, something similar to a bank account in case of a savings product, but here it's a policyholder's savings account, and on that account there are gross premiums put on that account paid by the policyholder, and from that account the insurer pays benefits and takes money out for paying the expenses. So the basic thing about the life insurance contract is that the insurer will make that always there is a non-negative amount in the savings account. So in the savings account, you cannot borrow in the sense that you cannot go below level 0. So in some sense, loosely speaking, the gross premiums always have to exceed the benefits and the expenses that are paid already. But we will come to that in much more detail. We will consider that in much more detail in chapter 7 on policy values. Policy value will essentially be the amount of money that has to be available at any time in that savings account. We will also consider single premium and regular premium contracts. Single premiums, we have seen that in the previous chapters. That's the single premium that you pay at policy issue, or the actuarial value, or the net expected present value that you pay. Regular premiums are premiums that you pay, for instance, yearly, as long as the policyholder, as long as the insured is alive. Now, there are some conditions about the premium paying term. So when can you pay premiums? The premium paying term may start before the term in which benefits are payable. As is shown here, the premiums start before the benefits start, but the premium paying term should not start later than the term in which benefits are payable. So it should start before this point where the benefits start. The premium paying term may also end before the term in which the benefits are payable. This can be seen also here in this picture. The benefits are in this period, but the premiums stop here. They may stop before, but the premiums should not end later than the term in which the benefits are payable. So that means premiums cannot run until after the benefits have stopped. Why is this? Why does this 4 reasons hold? Check it carefully. It is all about the fact that here in this policyholder's account, the amount that is available there must be non-negative. Suppose, for instance, that the premiums start after the term in which benefits are payable, then there are benefits payable already, so there is money taken out of the savings account before there has money come in. So that would mean that you go below 0 on the savings account, and that's not allowed. And the same kind of reasoning holds for the 3 other conditions that we have on the premium paying term. Okay. We will make some assumptions in this section and the technical in this chapter, and the technical basis in this chapter, which will be used in the many examples that we will consider, will be the standard select survival model that we have seen before in the previous chapter. There is a standard ultimate survival model, which is a Makeham law, and there is a 2-year selection period. The forces of mortality are adapted in the first 2 years, but in the first 2 years after selection, but the selection effect cancels out, we assume here, after 2 years. And we will also work with an interest of 5% in the examples. There are a number of tables made based on this technical basis. You can see them in Appendix D at the end of the book. There is a live table. There is a table with live table functions. That's table D1. And there are also annuity and insurance functions. So actuarial values of annuities, of annuity or life insurance contracts, let's say. And they are shown in tables D2, D3, and D4. A life insurance contract, in fact, gives rise to a number of cash flows, as we have seen already. There are benefits that the insurer will pay. There are expenses that the insurer will make. And then there are net premiums that the policyholder will pay. And apart from the net premiums, he also pays a loading, a premium loading for the expenses. We will denote the present value at contract initiation by PV0, or that's the present value at time 0 at the policy issue, but we will often denote this by PV, so we will not show the timing to which we take the present value to time 0. We will do that if no confusion is possible. Now we can define the net loss at issue. What is the net loss at issue? It's denoted by L0n. That's a random variable. And it is in fact the present value at time 0 of all the benefit outgo, all the benefits that are going to be paid, minus the present value at time 0 of all the premiums that will come in. So we talk about the loss because we look from the viewpoint of the insurer. A benefit payment is an outgo, is a payment that you have to do, it's a loss. The premiums that are coming in are in fact gains for the insurer. So therefore, if you talk about loss, the loss is what goes out minus what goes in. Apart from the net loss at issue, we will also define the gross loss at issue. What is the gross loss at issue? We will denote that by L0G. That's also a random variable, but now we take also into account the expenses. That means what goes out for the insurer is the benefit outgo and the expenses that he will make. So we take the present value at M0 of the benefit outgo plus the present value at M0 of the expenses. And what comes in are then the gross premiums. So for our gross loss, we take minus the present value at M0 of the gross premiums. Summarizing, the gross loss at issue is the present value at issue of benefit outgo plus expenses minus gross premium income. Important to remark is that the random variables L0N and L0G, so the net loss and the gross loss at issue, they are in fact random variables being functions of Tx, the remaining lifetime of the insured at policy issue. Now we make a convention. Let C underlined denote a cash flow stream. So in the sequel, we will very often denote cash flow streams by a capital underlined. The expected present value of the cash flow C underlined will be denoted by C. So if we omit the underlining, that means that we have a number, namely the expected present value of the cash flow or the actuarial value. Let us have an example, or some examples. AX underlined, that's a new notation, but we have already AX. AX was the actuarial value of a whole life insurance. Well, AX underlined is the underlying cash flow of this whole life insurance. So AX underlined is a notation for 1, a payment of 1 at the end of the year of death of the insured, so at time KX plus 1. If we do not underline AX, then we have the actuarial value of this cash flow. The same for an annuity. We defined already an annuity due. A.X is an annuity that pays 1 in the beginning of each year as long as the insured of HX is alive. Its actuarial value was denoted by AX. If we now underline the A.X, then that is a notation for the underlying cash flow. So that is a payment of 1 at time K, at any time K that goes from 0 to KX to the beginning of the year of death. So we will introduce similar notations for the cash flow streams of all life insurances and annuities introduced in previous chapters. We have introduced a lot of notations for actuarial values of life insurance and annuities in the previous chapters 5 and 4. Well, if we underline these notations, then we mean not the actuarial value of that life insurance, let's say, but its underlying cash flow. Let us start with the first example for pricing. We consider the net life insurance contract with benefits given by SA underline 60. So what is this? That is a whole life insurance on a person of age 60. He was selected at age 60, and there is a payment of S at the moment of his death. We underline this because the benefits is a cash flow. It's a payment of S at the moment of death of the 60-year-old person who is now just selected. And we assume that this contract, these benefit payments, are sponsored or are paid by net premiums. And what are the premiums? The premiums is, there is a premium to be paid. The 60-year-old person will pay 20 premiums provided he survives. So he pays in the next years from age 60 until age 80. He will, in the beginning of each year, pay a premium P, provided he is still alive. So at the moment that the insured dies, there is no premium payment anymore. So this is a contract where we describe the benefits, the whole life insurance, and the premiums, a series of premiums to be paid. Now the question is, write down an expression for L0N for the loss at issue random variable in terms of T60. Well, we know that the benefits is the benefits of a cash flow paying S at the moment of death. So the cash flow is S times a payment of 1 at the moment that the insured dies. What is the present value? The present value of the benefits is then S times V to the power T60. What are the premiums? The net premiums, as we have just seen, is a series of premiums according to a term life annuity. We pay a premium at age 60, 61, until age 79, each time conditional on the survival of the insured of age 60. Or if we write that in terms of cash flow, there is a premium P at any time K, where K goes from 0 now until the minimum of K 60 and 90. So maximal a payment until until time 19, but it stops earlier if the insured dies before time 20. What is then the present value of the premiums? The present value of the net premiums is P times a sum of factors V to the power K, where K goes from time 0 until the minimum of K 60 and 90. Or we had a notation for that. It's P times an annuity of a term and of a certain term, and the term is minimum of K 60 plus 1 and 20. So that means there are at most 20 payments each time at times 0, 1, 2, 90. So now we have for this contract an expression for the present value of the benefits and an expression for the present value of the net premiums. What is now the loss? The loss at issue is the present value of the benefit outgo minus the present value of the net premium income, or the loss at policy issue is given by this function of the remaining lifetime T60. So this is a random variable because it's a function of the remaining lifetime T60 of the insured. Now we have the equivalence principle. How do we define the premiums? Okay, if you look at the previous contract, we said this is the loss function, but we do not mention yet how the insurer, if he sells this contract, how is he now going to determine this P? Well, we will determine the premiums, or in practice, one determines the premium with the equivalence principle. What does the equivalence premium principle says? The expected loss at time 0, the expected net loss at policy issue must be equal to 0. If you still remember, the loss was defined as benefit outgo minus premium income. So the expected loss is 0, can as well be written as the expected present value of the benefit outgo must be equal to the expected present value of the net premium income. Or what does that mean? We will determine the premiums such that the actuarial value of what the insurer will pay is equal to the actuarial value of what the policyholder will pay as premiums. As I said already, the equivalence principle is the common premium principle in traditional life insurance, in classical life insurance, and in this course it will be the default premium principle. If we ask to calculate the premium but we do not specify how, it means you have to determine it according to the equivalence premium principle. Let us apply this to a whole life insurance contract. So we have the net life insurance contract with benefits S times AX. That means there is a payment of S at the moment that the insured dies, and the premiums are paid by a lifelong annuity. So the net premiums are P times A double dot X underlined, means there is a premium payment at the beginning of the year as long as the insured is still alive. Now we have to determine the net premium P with the equivalence principle. Well, we look at the loss at policy issue. The loss at policy issue is the present value of the benefit outgo. The present value of the benefit outgo is the present value of S times AX minus the present value of the premium income, so minus the present value of P times AX. And then the equivalence principle tells us the expected loss at time 0 must be equal to 0. Or if we look at this, we have our loss we take the present value of the loss, and then we take the expected present value of the loss. So we get the expected loss is equal to S times AX minus P times A double dot X. This must be equal to 0. That's the equivalence principle. And from that, we find the premium. The premium is S times AX overlined divided by AX double dot. Now here, in this example, it's easy to see that the premium is an increasing function of H, X. Indeed, AX is increasing in X. The older you are, the higher the expected present value or the actuarial value of your future benefits. Why? Because you're dead, the older you are, the closer you are to the moment that you will die. On the other hand, A double dot X decreases in X. Why is that? You get a lifelong pension. The older you are, the earlier you are to your moment of that, and the less will be the value of the actuarial value of all the payments. So AX is increasing in X and A double dot X is decreasing in X. So you easily can conclude that indeed P is an increasing function of X, which is to be expected. If you underwrite a lifelong life insurance contract at a certain age X and you pay that by lifelong premiums, the older you are, the more premium you will have to pay. Okay. Now let us have a look at the whole life insurance contract and compare the level premium that we just have calculated. The premium is S times AX overline divided by A double dot X versus the cost of 1 year cover. So I want, at the moment that I die, there must be a payment of S. If I pay this contract, if I buy this contract by constant premiums, level premiums, this is the premium that I have to pay. We have just calculated this by the equivalence principle. But let us now assume that I want to fund this life insurance cover in another way. I will pay from year to year the cost of the life insurance for that particular year. So for instance, if I am in the year K plus 1, at that time I have age X plus K, and I take the price. What is the price now of receiving 1 in that year between age X plus K and K plus 1, receiving 1 if I die in that year? Then the cost of that contract, that 1 year contract, is S times AX plus K for a term of 1, and X plus K has to die in the year. So we can, from year to year, in the end, we want an amount S at the moment that we die, but in this part here, from year to year, we buy a 1 year contract. So we are, in both cases, paying level premiums or paying yearly changing premiums. We are, in both cases, sure that at the moment that we die, there will be a payment of S. Well, for the level premiums, if you look here on this graph, we have the age of the insured on the x-axis, and we have the premium amount to be paid on the y-axis. If we go for lifelong level premiums, then the premiums are constant. If we look at the second approach, where we take the cost of the cover from year to year, then our mortality cost, or this life insurance, 1 year life insurance premium that we pay, will be increasing over time. Why is that? Because a 1 year life insurance is an increasing function of K. The older the insured is who takes the 1 year life insurance, the more premium he has to pay, because the more likely that he will die. So that's a difference. That's the premium payment here in case of lifelong premiums, in the case of level premiums, and that's the premium payment that increases over time in case of cost of 1 year cover. So what happens? What do we see? At younger ages, the premiums, the level premiums are greater than the mortality cost, thus earn cash value that is invested. So we take an insurance in the first years when we are young, we pay too much in our insurer's savings account. What goes out is the cover for the life insurance is cheaper. but in the later years, we still pay a smaller premium than the mortality cost now. If we get older, the premium is still constant here, but the cost for that 1 year cover is higher. How can the insurer pay that? Because in your savings account, in the early years, there was a surplus. So your savings account, your insurer's savings account was increasing in value from year to year until here. And from here on, what the insurer takes out, the insurance benefit, is higher than what you get in. So silently, the insurance account, savings account, is going to level 0. Let us now have a simple example. Consider you're 25 years old and you want an insurance contract that pays you 50,000 at the end of the year of your death. And you pay premiums for it P times A.25. So you pay lifelong premiums from age 25 on. We assume the technical basis, the standard select survival model, and an interest of 2.5%. And we look at the net yearly premium for that contract. The premium is 50,000 multiplied by A25 divided by A.25, as we have seen before. And this is approximately 365. So what does that mean? If I pay $1 per day, then if I pay $1 per day, more or less, to the insurer, that means I pay $365 per year to the insurer, and I pay that lifelong. Then at the moment that I will die, there will be a payment of $50,000. And that's this publicity, this campaign here is about, if you drink a latte and suppose that it costs $4 per day, you can do that. Or you can buy a life insurance for $1 per day. Well, or even here you could take the life insurance for $4 per day. If you buy a life insurance for $4 per day, at the moment that you will die, there will be a payment of 50,000 multiplied by 4, so 200,000 euro. That's the choice that you have to make. A latte a day costs you, or costs your family, when you die, in fact, $200,000 that they miss. Then we have an endowment insurance, example 6.2. Now we consider again a net life insurance contract, and the benefits is S times AXN. So that means it's an endowment insurance. There is a payment of S if the person of age X dies within the first N years, but if he is still alive at age X plus N, then there is a payment of S. So there is always a payment of S, early if you die before time N, or at time N if you survive until time N. And we assume that the premium payment is according to a term annuity. So you pay premiums, the insured, the policyholder pays premiums as long as the insured is alive, but not longer than N years. So the maximum number of premiums to be paid are N. And now the question is, determine an expression for the net loss at policy issue, for the mean of this net loss, and then determine the annual net premium for the contract. Well, the net loss at issue is the present value of the insurance benefit S times AXN minus the present value of the premiums that you will pay. And you could write this in terms, you could write this as a function of Kx, the remaining lifetime of the insured, and we have done this here. We have done this here. But now we do not need the present value of our future benefit outgoes minus premium incomes. We need the expected present value. So we need the expected loss at time 0. The expected loss at time 0 is then S times AXN minus P times A.xn. So you see, when you know the life insurance contract, you know the benefits and the premiums, you can look at the loss, and then immediately you find the expected loss by just forgetting about or deleting the underlying. The step that we do from here to here is a step that in practice you will not make. You will think of this and immediately write this expected loss. What is then the annual net premium? Well, the expected loss has to be equal to 0. So that means that our premium is S times AXN divided by A double dot XN. And if you still remember, there was a relation between an endowment, the actual value of an endowment insurance and the actuarial value of an annuity. And this was the relation that we have seen before. So if we use this relation in expression 6.2, we can also write that the premium, we can also write the premium as a function of S and an annuity, an actual value of an annuity. Let us now go to another example, example 6.3, which is a deferred annuity. So we consider the net life insurance contract with benefits X times A double dot XN bar 12. What does that mean? It's a deferred annuity. The annuity on the person of age X only starts in n years from now. So it only starts at age X plus n. There is a payment per year of amount X, but this payment is paid in 12 terms. So that means the payment, the pension per month is X over 12. And then there are also premiums paid. The pension starts at age X plus N, but premiums are only paid until age X plus N. So let's say age X plus N is retirement age. We pay premiums until retirement age, and then we receive the benefits, the pension, from pension age on. What are the premium payments? There is a total premium payment per year of 12p, but the premium is paid monthly, so that means the premium per month is p. And this premium is paid until retirement, until age X plus N, provided the insured is alive. The question now is, write down L0N, the loss at time 0, the loss at issue, in terms of the lifetime random variable of X, and derive also an expression for the premium. Well, first some extra information about a deferred annuity. The deferred annuity that we have just described has in fact two parts, that the future is separated in two parts. The first part until here is what is called the deferment period. The pension does not start here, and there is only premium income. So if you look at the policyholder's savings account, this savings account is only growing because more and more premiums are added over the years. And then from that moment on, here, the pension starts, and then the savings account is not growing anymore, it's just decreasing from year to year because a pension is paid out, a pension amount is taken out from month to month. Or you can also show that or illustrate that in another way. In this deferred annuity that we described, we have first the accumulation phase. Our savings account, policyholder savings account, is growing, and then after retirement there is the payout phase where the policyholder's account is slowly going down because there is no extra premiums paid inside, and there are pensions, annuities paid out. Let us now have a look at this problem a little bit numerically. So the loss at time 0 is the present value at time 0 of benefit outgo minus present value of premium income. So it's the present value of the deferred pension minus the present value of all the premiums that will be paid. Now we want the expected loss. We look at the expected loss. The expected loss is then given by this, the expected loss is then given by this expression here. And we have to set this expected loss equal to 0. We set the expected loss equal to 0, and then we find easily that the premium is given by this expression. That's our premium in this case. Now we adapt example 6.3 a little bit to example what we call 6.3 prime. We consider now the net life insurance contract where there is the deferred pension. The premium payment goes in the same way, so we pay a premium P in the beginning of each month until retirement. But now, if the insured dies early, suppose that the insured dies in the first 10 years, so that suppose that the insured dies before his retirement, there is also a payment S. So this is an additional benefit, that is a death benefit in case of death, early death before retirement. Write now down an expression for L0n in terms of the lifetime random variable of X and derive an expression for P. Well, the net future loss, it is easy to see that the net future loss is the present value of the benefit outgo, so the present value of the term insurance plus the present value of the deferred annuity minus the present value of all premiums that are paid. What is then the premium? We have to take the expected loss, and the expected loss setting equal to 0 leads to this expression here for the premium. The premium, the only thing that, well, that's straightforward, it follows immediately from taking the expectation and setting it equal to 0. We find this, and the only thing that we did here, our deferred annuity here, we wrote it in terms of EXN multiplied by A double dot X plus N 12. Okay. Then another example, example 4. Now we have a net life insurance contract with benefits 100,000 A 4520. So we have an endowment contract. If the person of age 45 dies in the next 20 years, he receives 100,000. But if he survives until age 65, he also receives the 100,000. The premiums are paid empty, so the year is split in M periods, and there is a premium paid P over M per period, and these are paid until age 65. And then the question in this example is we have to determine the premium in case M equals 1, 4, and 12. So if there is 1 premium payment per year, or 4 premium payments per year, or 12 premium payments per year, we have to choose a technical basis, and which is a standard select survival model and an interest, and then we can calculate the net premiums. The net premiums, the expected present value of the net premiums is the actuarial value of the premium payments of the annuity, the term annuity for 20 years. The expected present value of the benefits is the actuarial value of the term insurance. The equivalence principle asks that the expectation of the loss at policy issue is 0, and this gives us this premium to be calculated. Then in the information that we have, if we only have yearly information, if we have only life tables and actuarial values on a yearly basis, we have to make an assumption of mortality within the year, and then we have seen before approximations for this A double dot M 4520. Okay, and then as you will see in the book, you can calculate this premium for the different choices of M. Okay, this is the end of the first video on insurance premiums. Thank you.